Welcome back to Investing Talk Podcast.
Today we're looking at Sidus space.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's get into the analysis. The central narrative here is really a strategic pivot, and it's a painful one in the short term.
A painful one? How?
Well, we're seeing a classic case of short-term deceleration for, long-term growth. If you just look at the recent numbers, Q3 2025 revenue came in at what, 1.9 million year over year?
Exactly, a significant drop.
That kind of revenue decline usually sends people running for the hills. But you're saying this is all part of the plan?
Absolutely. This was a calculated choice. Management decided to shed these legacy sort of lower margin contracts.
Like what kind of work?
Things like component manufacturing, maybe some basic assembly services. They're dropping all that to focus very aggressively on these higher margin vertically integrated models. So it's a quality over quantity move.
Precisely. They are shifting almost entirely to space as a service and, this is the most critical part, defense as a service. They're sacrificing today's revenue for a shot at, well, a much bigger prize tomorrow.
And that pivot leads us right to the core catalyst, the thing that has completely changed the story for this company.
It does.
I'm talking about their inclusion as a contract awardee in the Missile Defense Agency's SHIELD program.
That is the golden ticket. I mean, to put the sheer magnitude of this into context for everyone listening, this is a program with a shared contract ceiling of $151 billion.
151 billion.
Billion. And that funding runs all the way through 2035.
So you take a company that's doing, what, 1.3 million a quarter in revenue, and you give them access to a $151 billion pie. The scale shift is just, it's staggering.
It is. It explains perfectly why the market reacted so violently to the news.
Let's pause on the mechanics of that, because the key word there is access. It's an IDIQ contract. For listeners who might not be deep in defense procurement jargon, what does IDIQ actually mean for Sidus?
It's a great point. IDIQ stands for indefinite delivery, indefinite quantity, and it means the revenue is not guaranteed. They don't have a check for $151 billion sitting in the bank.
It's just not a done deal.
No. But what it does mean is that they have passed the most rigorous qualification process imaginable. They are now one of a very select group of vendors who are even eligible to bid on specific guaranteed task orders within that program.
So it's the difference between being invited to the party versus just hearing about it from the outside.
That's a perfect analogy. And that invitation, that access, it creates a very powerful competitive moat.
Right, because once you're in, you're in.
You're in. Being part of SHIELD provides incredibly high barriers to entry and, really strong customer lock-in. These are typically multi-year awards, and they're often granted on a non-competitive basis to the vendors who are already pre-qualified, like Sidus.
This stamp of approval from the Missile Defense Agency, it essentially says their tech is exactly what the Pentagon needs right now.
It does, and it aligns perfectly with the Pentagon's Golden Dome missile defense strategy.
So how does a relatively small company like this align itself with something that sounds so advanced?
Well, that strategy is all about creating a layered, resilient, and very responsive missile defense architecture in space. They are looking for agility more than anything.
Not the slow legacy contractor.
Exactly. Sidus is focused on proprietary tech, specifically their LizzieSat platform, which has AI and machine learning edge computing built in.
So the processing happens on the satellite itself.
Yes, that's the key. They can process data and make decisions rapidly on the satellite before beaming anything back down to Earth. This kind of rapid decentralized capability is exactly what the Pentagon wants.
Okay, so the potential revenue is clear. A massive, massive gateway. But potential doesn't pay the bills. The market won't value a lottery ticket if the company runs out of cash next quarter.
Which brings us to the financial health.
And the elephant in the room. Profitability, or I guess the lack thereof.
That's the necessary point of skepticism for sure. This is a growth stage space tech firm, and they are deeply, deeply unprofitable. The net loss widened to $6 million in Q3 2025.
But the number that really jumps out, at least to me, is the EBIT margin.
It's stunningly negative. It's around, what, negative 676%?
Minus 676%. For anyone listening who doesn't live and breathe financial statements, what does that number actually tell you about the business today?
It tells you two things very clearly. First, their fixed costs are incredibly high. You've got the manufacturing facility, R&D, all the engineering staff. And second, the revenue they're currently generating from those shrinking legacy services. It isn't even close to covering those basic operating expenses.
So operationally, they are just hemorrhaging cash.
They are, relative to their current, much smaller revenue base. It's a burn rate that would normally be terrifying.
So how is this even an investable company right now? That just sounds like a ticking clock.
You have to counter that unprofitability with the single most important mitigating factor: liquidity.
The cash on hand.
Exactly. Management was incredibly strategic. Immediately after they announced the Shield Award, they went straight to the equity markets. And they were aggressive about
And
it.
the market just ate it up.
They did, because the market saw the optionality that came with the contract win.
Can you walk us through those capital raises? They happened pretty fast.
They did. It was a series of offerings. First, a $16.2 million offering and $1.50 per share. Then, shortly after, a $25 million offering at $1.30. And then there were reports of another $35 million on top of that.
So when you add it all up,
When you synthesize those raises, they significantly bolstered their cash position. We estimate the company now has approximately $35 to $40 million in liquidity, post-close.
that is a massive war chest for a company this size. What does that give them in terms of runway?
Well, if you look at their current cash burn rate, which is about $4.7 million per quarter, that new cash pile provides an estimated 8+ quarters of runway,
So 2 years.
at least 2 years. And that time is it's crucial. It completely mitigates the immediate risk of them needing distress financing or, panicking and taking on bad contracts just to keep the lights on.
And crucially, they now have more cash than debt.
A very powerful position for a scaling space company.
So the financing buys them time, and it's pretty clear where that cash is going. It's earmarked for growth.
Absolutely. It's going right into manufacturing expansion at their Florida facility, more R&D for LizzieSat, and scaling up personnel to get ready for these future Shield obligations.
This isn't money for stock buybacks or anything like that.
No, this is pure investment into the growth strategy.
Mm.
The market is viewing this dilution as necessary growth capital. They're building the capacity now so they can handle the contracts they expect to win tomorrow.
Now, moving to the stock chart, the technicals. The market has definitely reflected this fundamental shift.
Oh, for sure.
You pair a massive defense contract with a full bank account, and you get explosive price action. The stock surged, 470 to 500% over the past month.
It was a huge move. And
Yeah.
that isn't just retail buying. That is a major fundamental re-rating of the company.
That kind of parabolic move, though, it creates a ton of volatility, so paying attention to the technical levels seems pretty important right now.
It's paramount. And those recent offering prices, the 130 and 150 levels, are acting as incredibly strong psychological and technical support zones.
Explain that. Why do those specific prices carry so much weight?
Because that's where the big money came in. That's where institutional capital entered the stock. Large, sophisticated funds bought in right there.
So they're not going to let it fall below their entry point.
Not without a fight. It effectively creates a short-term floor for the stock, a support zone that will be really tough to break through unless there's some kind of, terrible news.
And that brings us to the sentiment analysis. Because it's not just retail enthusiasm. We have clear institutional validation.
We do. There was a Schedule 13G filing, which signals a large passive ownership stake. It revealed that CVI Investments and Heights Capital Management collectively took a 7.4% stake after those financings closed.
That's the institutional stamp of approval right there.
It is. Those funds clearly saw the strategic value in the Shield Award and were more than willing to absorb all those new shares. That news alone drove another 34% surge on high volume.
But it's not all sunshine and roses. We have to talk about the high short interest here.
Absolutely have to. The short interest has risen to about 14.7% of the tradable float. That's over 5 million shares currently betting against this story.
So what does that setup create? You have strong positive momentum, you have institutional buying, and you have extremely high short interest.
It creates a very volatile but high potential scenario for a short squeeze. If the company announces any strong positive news, let's say the first couple of meaningful task order wins from the Missile Defense Agency, all those shorts will be forced to cover their positions fast.
And that forced buying just adds fuel to the fire.
Exactly. That sudden buying pressure combined with the bullish momentum that's already there could just propel the stock even higher.
Which brings us squarely to risk. Let's outline the bear case. What are the two main risks that could derail this whole story, even with all that cash in the bank?
Number one is, and will continue to be, execution risk. We keep talking about that $151 billion ceiling, but Sidus has to win and execute specific dollar value task orders.
The revenue is not guaranteed.
Not yet. If they stumble in the bidding process or fail to deliver on an early order, that entire narrative just unravels. The IDIQ is an entry ticket, not the trophy itself.
And risk number two is the very thing that saved them. Dilution.
Right. While the market absorbed the recent offerings, they were still significantly dilutive. They eroded earnings per share, they increased the float. If the revenue ramp-up is too slow, they might have to go back to that well for more capital.
Continuing that dilutive cycle.
Exactly. So, connecting this to what's ahead, the near-term calendar is all about specific milestones, mostly focused on early 2026.
And first on that list has to be the SHIELD task orders.
Absolutely. The Missile Defense Agency is expected to start issuing those specific dollar value orders in the coming months. That will be the first tangible proof, the first real revenue translation from the IDIQ win. It's the proof point everyone is waiting for.
And on the hardware side, what's the next key milestone there?
The successful launch and commissioning of their third satellite, LizzieSat-3. That's scheduled for no earlier than Q1. That mission is critical, not just for capacity, but for validating their scaling model and expanding their high-margin data services.
Their data as a service model?
Yes. The margins on data areas are where the long-term profitability story really comes from.
And finally, we have the Q4 2025 earnings report, which should be out in early March 2026. Given everything we've talked about, the losses, the pivot, investors shouldn't even care about the Q4 numbers, should they?
They absolutely should not. Current profitability is totally irrelevant right now. The market will be focused solely on guidance for 2026 and any updates management gives on that SHIELD pipeline.
So if management sounds confident, the negative Q4 numbers get a pass.
They'll be entirely ignored. It's a purely forward-looking story at this point.
So let's wrap this up. Give me the elevator pitch summary for our listeners.
Okay. Sidus Space is a well-capitalized, vertically integrated space tech company. They have proven flight heritage. LizzieSat-1 and 2 are already up there working. Most importantly, they've secured a gateway into the massive, multi-decade U.S. space defense spending pipeline through that $151 billion SHIELD IDQ.
So the story is a transition play.
It's a pure transition play, where the market is valuing the future execution on that immense optionality and completely ignoring today's negative financials.
It's a bet on potential. Plain and simple. And here's the final provocative thought for you. The stock has had this massive surge, yet analyst price targets are reportedly still around $10.
Which implies the street believes substantial upside remains, even from here.
It suggests the institutional market is already pricing in SHIELD task orders that haven't even been announced yet.
So the key question for you, the listener, is this. How much of that massive $151 billion contract ceiling can this small, agile company actually capture in the next 12 to 24 months? That's what it all comes down to.
It's clear that while the road to profitability is long, that entry ticket into the defense space, paired with all that liquidity, it creates some really powerful optionality here. For us, the next quarter is all about watching for those task orders to land.
Watch those announcements closely.
If you want more in-depth analyses like this, remember to subscribe to the podcast.